Two countries, same continent. One is collapsing, the other is thriving. Which one are you betting your future on? March 2024, Stuttgart, Germany. A 70-year-old automotive parts supplier announces it's closing. Not going bankrupt, just closing. The owner's voice cracks as he says, "We can't compete anymore. Everything we built here is cheaper to do in America now." His workers have 2 months to find new jobs in a region where factories are closing, not opening. 2 weeks later, Toulouse, France. A defense contractor announces they're hiring 2,000 engineers. They have orders booked solid into 2027 and can't find people fast enough. Starting salaries are up 20%. Young engineers are relocating from all over Europe. The waiting lists for apartments are growing. Same month, opposite trajectories. This is the beginning of the largest economic rebalancing in European history, France and Germany. For 70 years, they were the twin pillars of Europe, but they built completely opposite economic models. Germany focused on export dominance, manufacturing excellence, and fiscal discipline. France chose state intervention, domestic consumption, and strategic industrial policy. For decades, both models worked and delivered prosperity. But now, the ground is shifting beneath their feet, and only one model might survive what's coming. Quick gut check. France or Germany for the next decade? Drop your answer in the comments. Because most people's instinct is Germany, the manufacturing powerhouse, the economic anchor of Europe. But that instinct might be completely wrong. And if your investments, career, or business are positioned based on that instinct, you could be on the wrong side of the biggest wealth transfer in modern European history. Europe isn't facing a normal downturn. Its entire post-war model is breaking down in real time. The cheap Russian energy that powered German industry for 30 years, it's gone. Permanently. The global free trade consensus, it's collapsing under tariffs and supply chain regionalization. The demographic dividend, it's reversed. Working age populations are shrinking, and pension obligations are exploding. When foundations shift, buildings don't all fall at the same rate. So which architecture will survive? Germany built the most successful export-oriented economy in modern history. The model was elegant. Take cheap Russian energy, combine it with skilled labor and world-class engineering, then export high-value goods globally. It was incredibly profitable for 40 years. But optimization creates fragility. Germany optimized for a specific set of conditions: cheap energy, open trade, and strong external demand. Those conditions have evaporated. Russian energy is gone. Natural gas prices are now volatile and weaponized. German industrial electricity costs are among the highest in the developed world. This isn't a temporary shock, it's a permanent structural change. German industrial icons like BASF are shifting production to China. Volkswagen is building battery plants in North America, not Germany. Siemens is expanding manufacturing in the US. German champions are abandoning German production because the economics no longer work. And here's where a difficult situation becomes catastrophic. Germany spent decades practicing fiscal conservatism, the famous Schwarz Null, or balanced budget obsession. So when the world changed and Germany needed to act fast, it found itself trapped. It had given up the financial tools to respond. There's no fiscal capacity to cushion the transition or build alternatives. German infrastructure is literally crumbling. Bridges are closed, rail systems are unreliable, and schools have broken heating systems. The country that lectures everyone about fiscal responsibility didn't even maintain its own capital stock. Meanwhile, demographics make everything worse. The median age is 46, the birth rate is low, and the working age population is shrinking. Fewer workers have to support more retirees. The math just doesn't work. But here's where the conventional wisdom breaks down. While Germany is trapped, France, chaotic, bureaucratic, often mocked France, might have accidentally built the more resilient model. For decades, economists criticized the French model for too much regulation and a bloated public sector. And those criticisms were true. France has massive problems, but it also has something Germany desperately lacks: strategic flexibility through diversification. France maintained a diverse economy. Yes, manufacturing, but also agriculture, tourism, luxury goods, aerospace, defense, financial services, and crucially, nuclear energy. When one sector struggles, others can compensate. What once looked inefficient now looks like insurance. France invested heavily in nuclear energy while Germany was shutting down its reactors. Now, France has energy independence and some of the lowest electricity costs in Europe, while Germany burns more coal and imports expensive LNG. But here's France's hidden advantage. The one markets are still mispricing. France maintained its defense industrial base, while Germany let its military capacity wither away. Now, with European defense spending set to double or even triple, there are hundreds of billions in new contracts on the table. Germany has to rebuild its entire defense industry from scratch, a project that will take at least 10 to 15 years. France never let that capacity disappear. Dassault builds fighter jets, Naval Group builds submarines, and Thales produces defense electronics. Of course, this advantage depends on European political will to actually spend that money. It's not a guarantee. Let's talk about the fiscal situation. Yes, French debt is high, but the state can still borrow at low rates. It can still invest and adapt. Germany, which refused to build up that capacity when borrowing was practically free, is now paralyzed. In a forced economic transformation, the ability to deploy capital matters more than the existing debt. Here's the critical difference. French problems are political. German problems are structural. Political problems can be solved with political will. It's difficult, but possible. Structural problems require decades of adjustment that might not be possible at all. France could reform its labor markets tomorrow if the consensus emerged. Germany can't easily replace Russian energy or reverse its demographic decline. Which set of problems would you rather have? Here's a scenario that markets treat as impossible, but is entirely plausible. Within 10 years, France could have a higher GDP per capita than Germany. German industrial decline is accelerating while the French service economy remains stable. German demographics are worse, but French fertility is higher. German energy costs are structurally high, while French costs are competitive. Markets haven't priced this in. German assets still trade on their historical reputation, while French assets trade with a dysfunction discount. That mispricing creates a massive asymmetric opportunity and a huge risk depending on where you're positioned. You often hear that Germany is just better run than France, the work ethic, the engineering, the efficiency. You're not wrong about that. But superior management doesn't overcome an obsolete business model. Germany optimized brilliantly for a world that no longer exists, while France remained inefficient but adaptable. In stable times, optimization wins, but in chaotic times, adaptability is king. The next decade will be defined by massive shifts: the energy transition, reorganizing supply chains, new defense spending, tech competition, and climate adaptation. Most of these megatrends actually favor France's structural position. Of course, this isn't a sure thing. If energy storage technology advances rapidly, Germany's bet on renewables could pay off. If the US strengthens its security guarantees, European defense spending could level out. And if China's economy stumbles, France's domestic focus loses some of its shine. Nothing is guaranteed. It's all about probabilities. But the base case seems to favor France. So, what are the practical implications? For real estate, German property in industrial regions carries a serious downside risk. What are economic powerhouses today could become the Rust Belt of tomorrow. Meanwhile, French property and service economy cities might be undervalued. For careers, if you're in advanced manufacturing or automotive in Germany, you're likely facing wage pressure and job insecurity. But if you're in defense, aerospace, or nuclear energy in France, you've got structural tailwinds. For business, building manufacturing in Germany means high energy costs and uncertain supply. Building in France means dealing with bureaucracy, but facing lower energy risk. And for investments, German export-heavy companies face persistent headwinds, while French companies focused on domestic consumption and defense have a more stable outlook. This isn't investment advice, just a framework for thinking about a rebalancing that most people aren't talking about. Now, let's discuss the scenario almost nobody talks about, but it's at the heart of Europe, a systemic risk. What if the euro itself does not survive this divergence? The euro was built on the assumption that economies would converge, that southern economies would catch up to northern productivity. Instead, we got divergence, and it's accelerating. A currency union needs either a full fiscal union or very similar economic cycles. Europe has neither, and the gap is widening. If German manufacturing slumps while French services stabilize, the ideal interest rate for Germany will be radically different from the one for France. The European Central Bank can't set two different rates. Someone has to lose. How long can that tension hold? This isn't a prediction of a euro breakup. It's an acknowledgement that the risk is significantly higher than the market is pricing in. For anyone holding substantial long-term assets in euros, like real estate, bonds, or pensions, that tail risk matters. A lot. The timeline is key. If this plays out over 5 to 7 years, we can manage the adjustment. But if it happens in just 18 to 24 months, the dislocation could be severe. The patterns we assumed were permanent, German industrial dominance, French stagnation, are breaking down in real time. New patterns are emerging fast. The question isn't whether you believe this analysis, it's whether you're prepared for a world where it proves correct. Most portfolios, career strategies, and business plans are still built for the Europe that used to exist. That's no longer the base case. That's now the optimistic scenario. The new base case is energy rebalancing, an explosion in defense spending, and regional supply chains. Most of these dynamics favor France's messy flexibility over Germany's elegant optimization. This doesn't guarantee French success. France could squander its advantages. But France has solvable problems and emerging opportunities, while Germany faces structural traps with limited solutions. For those over 50, the calculation is fundamentally different. The goal isn't building wealth from scratch, it's preserving what you've already accumulated. Your retirement income, your property values, your pension security. At this stage, avoiding catastrophic loss is more important than chasing upside. If your assets are heavily concentrated in German industrial exposure, real estate, pensions, business operations, you're facing a silent, compounding erosion of value. Diversifying away from that risk might be the most important financial decision you make this decade. The invisible fractures in Europe's economy are becoming visible cracks. The question is whether you recognize them before or after the consequences show up on your balance sheet. The next European crisis won't look like 2008. It will be a slow, structural rebalancing that most people won't notice until it's too late. 5 years from now, this will all be obvious. But by then, the opportunities will be gone. The Europe you knew is already gone. Your strategy needs to account for what's replacing it. If this reframed how you think about European risk, you know what to do. Thanks for watching.